Okay, our next company is a little bit more complicated. Recall in the past we were buying the shares of the sample company of the S corp, the sub company, sorry, using cash, as it says here. Previous examples we use cash. However, in this case, we're going to use stock. So our parent company is going to issue stock, its own stock. So it's going to do that for several reasons. That way, I'll save cash. Um, that's kind of there's some other benefits too, as it says it allows subsidiary shareholders to have a tax-free exchange. So there's some reasons why this might be attractive to it. But what we need to do is understand how we're going to deal with this. Now, one thing we need to know is that we're buying all of the sub company. We're buying 100% of it. So let's go to the next page and we'll see that what we're doing is parent is giving 20,000 shares, and in exchange is getting 10,000 shares of the sub company. Why is it giving 20,000 and only getting 10,000? Well, the shares are worth different. They have different values, right? Just like on the market, one share could be worth $50 and one share could be worth $10. So it just depends on the market value. Let's look at the subsidiary company. So this is the sub company right here. This is the one they're buying. And you see that the market value is sometimes higher than the book value of some of the assets. Buildings, for example, is a good example. This one is a $150,000 book value because you take the building minus the depreciation and you get 150, and they feel that the market value is worth 250. The total value of the assets on fair market value is 505,000. When you subtract out the liabilities, you see that the market value is worth the net value, of the company is worth 365,000. So they're giving 500,000 in exchange for 365,000. Here's the journal entry that would be made when they made the purchase. This would be the real journal entry. Investment in sub, right? And then here's the parent company stocks that they issued to get the subsidiary. And then these are fees, that you have to pay, legal fees, fees to record the stuff with the state. One schedule that we find useful is the value analysis schedule. The NCI stands for non-controlling interest. So if we didn't buy 100%, let's say we bought 95%, there would be 5% of the stock of the company sitting out there that's owned by somebody else. Now that 5% would not have a lot of weight. They wouldn't have a lot of say in things, so they call it non-controlling interest. But we need to keep that in mind when we're doing the consolidation so that all of our numbers kind of work out. So we feel that the company is worth 500,000. How do we know? Well, that's what we paid for. We gave $500,000 worth of stock because we feel that's what it's worth. The fair value of the assets is 365,000, as we saw here. That means that we paid an additional 135 beyond the net value of the company because we feel that there's some hidden value in the company somewhere. And that extra value is called goodwill. Now, when we look at the transaction, one of the schedules that could be useful for us is called the determination and distribution of excess schedule, or they call it the D&D schedule. For those of you that played Dungeons and Dragons when you were a kid, I always get a smile on my face when I hear that. But that was a long time ago. Anyhow, looking at this schedule, all it's really doing is just kind of helping us organize the information in our heads. So it kind of makes things easier when we do our worksheet. So we know we paid 500,000 for the company. We call that the implied value, and the reason we say it's an implied value is because if we paid 500,000, it must be worth 500,000. The book value of the company, assets minus liabilities, is equal to equity. So the equity is the net worth of the company on the books. So here's what it's worth on the books, the company, that the value of the equity, and since we own 100% of it, then everything just kind of flows into this column. We don't have to worry about this column at this point. What's left over beyond the book value then goes down to the distribution area. We're going to distribute it to the new assets. To the assets that we purchased at the new value, right? So it went from the book value to the fair value, so it went up by 5,000, 30,000, etc. All these add up. Do not add up to 340,000. All these add up, they're still short by 135,000, and that's because we feel that that's the goodwill of the company. So if we look at, when it's time to do the consolidation, on our consolidation worksheet, we see the elimination entry, and so what we want to do is we want to get rid of the common stock, that the equity from the subsidiary, and get rid of the equity or the investment, right, just like we did before. And then we need to distribute just like we did before, so that 340,000 is distributed amongst the assets that were written up to fair market value with the additional goodwill put on the books. Let's look at the worksheet real quick. So the worksheet, again, been through this a few times now. The parent and the sub before the consolidation, debit balances are positive, credit balances are negative. That's just so you can put things into one column. There's no negatives and positives in journal entries, as we know in accounting, but that's just to make things into one column. It's a one column approach. The eliminations go back to two columns, debit and credit column. The elimination entry is going to get rid of the equity in the sub, because we're going to be adding their assets and liabilities, and we don't want to double up on that. And then the elimination entry goes against the investment in the sub. Now, they paid $500,000 for a book value net worth of 160, equity of 160. So now we need to distribute that across and increase the assets, so that now the assets for inventory, for example, we add the parent and the sub plus the fair market value, updated it to a little bit higher, and now we have the new values over here. This will increase everything, and then it will also add the goodwill.